We're here in Monte Carlo for the Rendezvous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by James Vickers, who's Chairman Gallagher Re International. James, welcome.
Richard, thank you very much.
Thank you very much indeed for joining us. So you're a veteran of Monte Carlo's. Several delegates described last year's Monte Carlo as one of the most important in history. How's that interpretation played out?
I'm not sure it was the most important in history, but it was an important event because it did set the expectations about what the 24 renewal was going to look like, particularly around the key issues of pricing and perhaps more importantly, levels of attachment. And that has played out during 2024. We've seen in the first half year 2024 around about 60 billion of nat cat losses. The vast bulk of those have been retained by the primary market. So the reinsurers' attempts to move themselves up from what they see as attritional losses has been successful. And we can see that in the half-year results that have come out, where obviously reinsurers' results are pretty fantastic. And if you look at the ROEs, I know it's only the half year, they're all in the late teens, mid-20s. So from the reinsurer's point of view, what was predicted in 2023 has played out quite well in 2024. From the client's point of view, of course, it's a slightly different subject. Clients realized that reinsurers had lost quite a lot of money over a couple of years, over a number of years actually, and that they needed some correction in pricing. And that is what took place. What I think a number of them have found difficult is the change in structure. And that has created a question mark in their mind about the value of reinsurance. They're obviously going to buy reinsurance. They have to buy it. Yes, there are alternatives they can look at in terms of equity or debt. But at the end of the day, they were always going to be buying a reasonable amount of reinsurance. The question is, what are they getting for what they're spending? And if we look at the pretty fantastic results for 2024, I think that is particularly highlighted as we're here in Monte Carlo looking forward to the 25 renewal.
So what can insurers expect this year?
Well, what they'll hear from reinsurers is that although they've had a very good results, they've only just made up for the past losses they've had. Reinsurers will be talking about the need to maintain price adequacy. They will be talking on the long tail lines about social inflation. Some of them may be talking about the impact of interest rates beginning to ease. I have to be honest, I don't think any of that's going to be particularly interesting for the buyers. The buyers will be looking at their own portfolios, their own issues, and they will be pushing hard not only on price, but particularly for small and medium-sized companies, they will be looking at structure. They have been retaining too much of the volatility that the reinsurers used to provide with low-level covers and aggregate. They want that to be addressed. And that's where the battleground will be. Reinsurers aren't silly. They know that this is a pinch point. And some of them are trying quite hard to offer solutions, particularly maybe on a structured basis. But what the buyers would really like is what they had a couple of years ago, which was straight in aggregate covers and low-level covers. Those are probably unlikely to come back. But something needs to be done for those clients. At the same time, we are seeing natural growth. So a lot of buyers are coming to Monte Carlo, they will want to buy more limit. Yes, original rates movements are not quite as great as they were, but they're still there. So the tailwind of rate increase is still there. The challenge is really that as that drops and inflation reduces gradually, are the primary companies still going to grow? And the answer is a lot of them will, and that creates a demand for more cover. And what we see is there'll be a lot of leverage between the middle and top layers of programs that reinsurers would like to write. They want to lean in to write those. they'll be leveraged against, well, what can you do to help me at the bottom end?
So what you talked about some of the alternatives that insurers might have in that conversations with the reinsurers. How realistic are they, and where might they develop?
Well, I think what you have to sometimes, as reinsurance brokers and reinsurance practitioners, we need to take a step back and really understand the client motivation. What are they buying reinsurance for? It's something we in Gallagher Re spend a lot of our time with our clients. What are you buying it for? Are you buying it for capital protection? Are you buying it for volatility protection? And depending on what the answer is, you can look at alternative sources of capital, raise more equity, debt, other instruments, or you can look at reinsurance. And reinsurance has to be balanced and shows how it performs between all of those areas. What has, as I said, developed a lot is structured reinsurance, where basically to help on the lower level, high volatility layers, they're placed on a multi-year basis, and the question of time comes into it. And that can be certainly helpful in some cases.
We are, or we have been in a hard market. That's a real chance for brokers to show their worth. Tell us a bit about your experience of this cycle.
Yes, you're right. I think when clients are faced, well, we haven't actually had a lack of capacity. What we've had is dramatic changes in price and structure. And that is where a good broker comes into their own, who can help the client navigate their way through these complexities, manage the relationship with the reinsurer to find what is an acceptable solution. There's a huge amount, as you know, of analytical work done by brokers in trying to explain to clients the values of different structures and how they work. And then similarly, once the client has alighted on a preferred structure, using the same analytics to try to persuade the reinsurers that this is what the client needs, the underlying reasons why they want to buy it, this is why the structures are put together, and this is what they can afford to pay. So that bringing together of both parties, underpinned with a very, very deep technical knowledge and a deep understanding of the client and the client's demand, as well as, to be fair, an understanding of the reinsurer's own risk appetite, is the differentiating factor in a hard market. In a soft market where business is easy to place, those sort of skills, those transactional and analytical skills, are less highly valued.
So AM Best has a positive outlook on the reinsurance segment. Obviously, that's great news for reinsurers here in Monte Carlo. How enthusiastically will that be greeted by the insurers and the clients?
Well, look, as a reinsurance broker and also as our clients, we need the reinsurance industry to be healthy. We need the reinsurance industry to be financially strong, to provide stable, long-term, sustainable capacity. And we understand that to do that, they have to make a reasonable return for their investors. Everybody understands that. So it's in nobody's interest to have a weak reinsurance industry. The question is, are the returns getting a little bit outweighed? And some recent analysis we've done indicates that the past losses the reinsurers suffered in 2017, 18, 19, and 20, they have now more than made that back up again over the last couple of years. So we do need to move back into a bit of an equilibrium. And we need to be careful about reinsurers not producing outsized returns compared to their primary clients.
James, thank you very much indeed for joining us.
Thank you very much, Richard. Pleasure.
For AM Best TV, I'm Richard Banks.